In this video, we're going to be explaining HSBC's investment outlook of Q4. Where are these guys putting their money? What are they investing in? And where do they think the markets are going to go? Let's see how we can take this knowledge and apply it to our trading. So we look at this report and you've got to think, are they right? I mean, when we look at this, the Fed, after this week, have they done their job? Have they finished raising interest rates? Do they think they've done enough? Because if they do, there is a prime opportunity here, especially if you like equities like myself. History has taught an important lesson that the 6 months following the last Fed rate rise, you can see that corporate bonds and equities perform well. So if this is the case, it's time to turn our attention to look at the equities market. Overall, when we look at this as well, the equities market hasn't done bad. It has been performing very nicely. However, PE ratios have run up. That's profit earnings ratios. For those that don't know, give it a quick Google and do some research. But with PE ratios moving high, it's now about finding the perfect stocks to buy that have got a low PE ratio with good upside potential. So with this in mind, this is one of the challenges that investors are going to have when they start looking at the Q4 and whether or not they believe the HSBC investment outlook. If they do, then equities have got potential upside. So now it's about honing your skill set to be able to pick the right equities for you. Some tips there for you to take away: low PE ratio and a good fair value for the stock is first points to look at if you're ever investing in stocks. So one of the biggest risks with this is obviously equities have run high anyway, even during this period of interest rate rises. So it's about trying to find that needle in a haystack. Where is a good stock that has still got a good PE ratio? Because PE ratios have run up quite highly over the last few months. Those are some basic points to look at if you are interested in the equities. Let's carry on breaking down this report. On top of this, HSBC have pointed out quite clearly that they expect the US to start cutting rates a lot quicker than Europe. So what does this mean? This means that overall, the US markets are going to benefit from this a lot quicker. The US also has a good benefit in the markets from AI and tech companies. So looking at the US stock market is probably more ideal right now than the European markets. So which sectors are they looking at? They're looking at predominantly healthcare, financials, and consumer discretionary. These are the areas of interest to HSBC. And arguably, in our latest stock report, we talk about a medical company that we found quite interesting with good fair value and good dividends. So it's nice to see that we are on the exact same track as what HSBC are looking at in the markets. What is HSBC's portfolio strategy exactly? Let me break it down for you. It says that the end of the Fed rates decision is near. This is a clear positive for the bond market. What that does is that really pushes IT, information technology sector, mega caps, producing gains within the markets because they think that rate cuts are over. But overall, there is still room for these stocks that have been underperforming, that have got good PE ratios, good fair value, good dividends to now start taking off. So HSBC are starting to diversify into those sectors within the equities market. They also think that there's going to be added volatility. So they've added into this volatility strategies. What that exactly entails, I'm not too sure. However, something like that for myself will be trading the volatility index, such as the VIX. They've also added diversification here by investing into hedge funds as well, which widens their portfolio. So at this moment in time, if we're to categorize what HSBC are investing in, cash, they are underweight. Secondly, fixed income. They're focused on high quality borrowers and they're overweight on this part of their portfolio. On equities, they are neutral. They're currently overweight on US stocks, Latin America and Asia, and they're currently underweight on European stocks. This goes hand in hand with what they was talking about how they expect the US to cut rates a lot quicker than Europe. In alternative investments, they're overweight as well with their investments into hedge funds and real estate. Let's look at this from a broader fundamental aspect from a macroeconomics point of view and break down exactly what they're looking at. So on this chart, you can see on the top left here, we've got back in there stagflation from 2022 when recession fears were at the highest point. And this is where individuals were focused on keeping cash. Cash is king. And also then looking at defensive sectors within the markets. And as such, a good example of that could be stuff like utilities, oil and gas, water, stocks like Severn Trent, things like that. So you can see on the top right, it then got to the point where inflation was less of a concern, although investors were still focused on the defensive sectors, whereas sort of like growth and IT mega caps were still outperforming. Now, in the most recent months, you can see if we look down in the bottom corner of the chart, the fears of recession have sort of dispersed, and it's not really something that people are thinking are going to happen in the investment space. And this whole talk of soft landing approach seems to be on the horizon, and it looks like it might actually happen. So with this has become this whole sort of risk on market where they feel that the Fed's at the end of their interest rate rise, and we're seeing the equities have a good run off the back of this. As well as this, with this sort of risk on environment, we've also seen cyclical stocks start to have a good rally in the marketplace. So soft landing, is it going to happen? Looks likely right now. So in the final corner, you can see where HSBC think we're going to be moving to. So with this, they're calling this economic resilience, and they're calling it sort of like a growth okay market of what we could potentially be looking at. And this is where they anticipate that they see an increase in equity value stocks, also in materials as well as commodities as the main focus point here. On top of this, from an FX perspective, they anticipate to see further US dollar strength, which also backs up our previous report that we saw from Goldman Sachs on my YouTube short video about how they anticipated that the US dollar against the Japanese yen could reach over 155. This is why I find bank reports so important, because it gives you a great outlook of where the market's going. So we're going to be looking at HSBC's top 4 trends of exactly what they're looking at in Q4 of 2023. At their core focus, they're looking at digital transformation. So what does this involve? AI and automation is at the top of their list, followed by aerospace, and then also followed by smart mobility. So this is what they're going to be focusing their attention around, assuming with their strategy that they're looking at in Q4 around equities that are involved in these different areas. Secondly, they're looking at opportunities amid peak rates. So they're looking at companies that are American based, that are very resilient, that have good dividend yields. This is predominantly around the US healthcare as well, as they see the opportunity there. As well, if we look at the report earlier, looking at a good PE ratio value on that. They're also looking at some other aspects here that you can see within the chart. And then the last 2 points, they look like on the graph that they're sort of valued at the same amount. So when we look at this, one is sustainability and one is investing into Asia's boom. Now this is both quite interesting aspects, completely different. So let's start with Asia. They're looking at remaking of Asia's future. There's been a big amount of consumer spending, and it's a big boom at the moment within Asia, and this is what they're focused on. This is ranging from the likes of green technologies, but they're also looking at good quality credit as well. They're also looking at rising tigers as well within the space in Asia. So it's quite nice to see this sort of diversification away from their core concept of what they're looking at from AI automation around US equities. This has given a bit of diversification over to the Asian markets. The final point they're looking at here is what they've labeled as investing for a sustainable future. On the list here, they've got investing into biodiversity. They talk about wellness as well, and also sourcing income in a sustainable way as well, and social empowerment and well-being. So let's focus finally now on their 3 highest convictions of what they're focused on. You can see here that they're looking at AI and automation. AI and automation, as I'm sure you're aware with ChatGPT and all the other different AIs that are coming up, is creating a big boom within the markets through efficiencies, time saving, and ultimately it might be beneficial on the bottom line for certain companies. Also, from a growth aspect of new stocks coming into play, it makes full sense why HSBC's investment outlook is focusing on AI and automation. Secondly, we can see aerospace here, and you can also see at the bottom on this graph, you can see cost per kilo of putting an item up into space has dropped dramatically over the years. This is going to open up a lot of doorways to new tech, small satellites coming into space, and how those aerospace companies take full advantage of that. And also a lot of the big companies on the ground, it now makes it a lot easier access to be able to do that. So it makes complete sense why, again, they're focusing on aerospace. Great example of this would be SpaceX in regards to their satellites. Great Wi-Fi, it's something that I use myself, And these mini satellites that are going up allow for a lot more technology, and also allows for a lot more competitors to be able to put small satellites up of their own for their own products. And it makes complete sense of why this is an attractive area to invest in from HSBC's point of view. And finally, smart mobility, as it says here, that the younger generation of adults are expecting that their transportation to be a lot greener, a lot smarter, all the functionalities that these guys want on apps. So smart mobility again makes complete sense, because the expectations of travelers and consumers are demanding a lot more from both an eco-friendly perspective, but also from a tech advancement aspect as well. The one area that I found very interesting here was the Asia side. It's an area that I haven't really looked at from the consumer spending boom, but I'm definitely in full agreement by focusing on low PE ratio companies that are US based, that have great dividend yields. If you've enjoyed this video, make sure you hit the subscribe button. I'll be sure to be posting more banks outlooks in the near future, so stay tuned.